and welcome to this special episode of WPTV. My name is David Katai, Senior Editor at Wealth Professional. The Wealth Professional Awards celebrate how this industry has moved forward, embraced change, and innovated to serve clients. One of the most exciting areas of progress in this industry is in its use and adoption of alternative investment strategies. The ICM Asset Management Award for Advisor of the Year Alternative Investments highlights the one advisor who has offered an outstanding level of an alternative strategy in their client service. Chad Larson won that award this year. The partner and senior portfolio manager with MLD Wealth of Canaccord Genuity Wealth Management literally wrote the book on alternatives in client portfolios. Chad joins us now to discuss his award win. Chad, welcome to WPTV.
Oh, thank you so much for having me.
So Chad, just off the bat, why do you think you won this award?
I think so I'll preface this is that it's, somewhat self-promotional, and thank you for the platform on which to, be recognized by your organization and in front of my peers and colleagues and clients to be humble, but also to get the value proposition across. I think it starts with, bold leadership rooted in deep expertise and really what's become a consistent delivery of innovative solutions and the creation thereof in the alternative investment landscapes beyond traditional stocks and bonds. And it's something that has become core is a tough word. I don't want to pigeonhole ourselves so that it's all that we do, but we've carved a niche and unique relationships and subject matter expertise within the segment of alternative investings and quite literally wrote the book. I did author a book last year and publish it called Beyond Traditional as a guide, a modern day guide for alternative investors to give back and create an educational platform to help clients understand more about the opportunity sets in untraditional asset classes. That work has really, I call it helped our high net worth clients preserve capital, manage risk, and access unique opportunities, establishing, years and years of trust and performance.
hmm So talking about those years and years of trust and performance, let's go back to the start. When did you start putting alts into client portfolios, and what were some of those first assets that you started giving them exposure to?
I've always said I've been doing alts since before they were cool. I go back, they obviously there's a lot of tailwinds to the sector. They're getting more media exposure. Retail clients are becoming more aware of what they are, and we're using the word alternative investing or alternative investment seems to be kind of sprayed everywhere these days. But it was well over 10 years ago, I'd say 12 to 13 years ago, the first alternative investment that we made from a material standpoint as a structural or tactical shift was in, we had near US dollar parity, we had a hyper concentrated growth market and population growth in some of the Sunbelt states throughout the United States. And we've helped in partnership with a group out of Toronto, we helped form a first of its kind structure whereby we were able to aggregate and do direct investing into US multifamily real estate under the thesis that we had, currency tailwinds in our favor with a near US parity to the US dollar. We had cap rate compression opportunity from the aggregation of a portfolio, and we had the ability through strong leadership to see NOI improvement, net operating income, and that this ultimate portfolio approach would result in, in a takeout. So we made a significant investment and helped form a structure whereby we had, RSP eligibility for a private asset, but within a limited partnership structure, and it worked out incredibly well. And that really kicked things off where we saw the ability. It took a lot of work to create the structure. It took equally as amount of work to educate the client and have them comfortable with doing something outside of traditional stocks and bonds. But the net results of that, really kind of kicked us off down the path where our clients look to us to, investigate, create, launch, and manage unique structures to access different aspects of the capital markets or investment landscape.
That's a really fascinating example for the sense of it. It kind of speaks to almost the two different definitions that are used for alternatives. One being private assets, things that are not held and accessible in public markets with all those liquidity questions and everything else that comes with it. And then the other side of more sophisticated strategies, different packaging, different forms of structuring these deals and these assets in a way that, again, makes them RSP eligible, makes them maybe a little more liquid, makes them, those two sides. Would you say that's kind of a fair characterization of like you're managing to blend those two aspects of the broad category of alternative investing in these pieces that you've created for your clients?
Oh, absolutely. Like on surface, you hit the nail on the head. I think, obviously creating wrappers, packages, vehicles and modalities in which retail clients can aggregate, and be able to access these types of investments. That's kind of step one. And more people are figuring that out. It's manufacturing, it's the sausage making, which capital markets has become famous for. Creating ways to get investors money is job number one by most investment bankers, and equity capital markets groups. But even further, the devil is in the details, and it's on the structuring of the plumbing inside of those alternative investments that really, for both from a diligence, risk mitigation, management, and taxation leakage, we're largely dealing with different currencies, different tax regimes, being able to just invest into a Canadian feeder, which then has a cross, border wrapper, which allows investors to invest in the US master. A lot of the times you fee on fee on fee, and you kind of create this turducken effect where, you kind of are invested, but with so many layers, the experience and the net results. So taking it one level further and being able to navigate structuring whereby, we've had success at creating, direct access, in through jurisdictions like Luxembourg, Cayman, Delaware, et cetera, with not avoiding, the onerous and costly burdens of creating, Canadian feeders, but by really positioning ourselves with the underlying managers based on the amount of capital that we are able to allocate, that we are treated like that of an institutional partner to keep costs down and performance in the hands of our investors who are taking on the capital risk.
Of course. So you mentioned your book, Beyond Traditional. And, at this point, you wrote it after a solid amount of time managing alternative investments, but still to go out there, put your name out there and sort of write a manifesto. What made you want to write it? And how does it kind of reflect the approach you've just outlined to me?
Sure. Yeah. Again, I practice radical transparency as part of my life. I work and traffic within the trust business. And so to be honest and authentic of why you do things, part of it, absolutely was, partially filled the vanity bucket. It was something that I do enjoy creative writing. Maybe through retirement, got to spend more time exercising my pen, so to speak, instead of my Excel skills in doing financial analysis. So first off, I enjoyed writing, and I thought, wow, wouldn't this be cool? But what did I want to write about? This was the first genesis of what we wanted to do. And the knowledge base, or so to give back to also to the investor base, my private clients, prospective clients, and industry as whole, is there's a lot of unknowns of what is like just alternative. It's basically this large bucket that's not a conventional stock or bond. So to kind of demystify and it act as a guidepost, I don't call it a toilet read where it's just very light on content. It's really meant as a guide. It's really there to identify all the various types of what could be considered an alternative investment, identifying who is an alternative investor, why, identifying what that client should be looking for, just to help give back. And it's been phenomenally successful and complementary, from our existing client base, but where people have reached out curious to know more. I think a lot of advisors have treated alternatives like single use things that they're, based on past performance or, a unique value proposition specific to that one strategy, that one manager, or whatever it might be, when truly alternatives in themselves are a portfolio, is how I view them. Even within the existing food groups or asset classes of alternatives, I would say the four key ones being private equity, private credit, infrastructure, real assets, and hedge funds. Within each of those four food groups, there's like 100 other ways to slice each one of those. Now, I look at private credit alone. It's like, what are we doing? Asset-backed lending, first lien, subordination, mezzanine facilities, debtor in possession, ABLs. Like there's enough acronyms and terminology in there to confuse people. So to kind of demystify that, some of the purpose of the book was to say, private credit is not just private credit. And private equity is not just private equity. And so really to understand and say, when we create and curate, the more knowledge the client has, the better off they're going to be in the decision-making standpoint. Because, my background in economics and, prior to taking an economics focus and completing that degree, I was down the path of becoming a psychologist and took a lot of psychology. On a day-to-day basis, I tell people how you feel about your investments is equally as important as what you're invested in. And that really starts with knowledge.
Mhm. So, first of all, fascinating. You've touched on so many of the themes I've heard through covering the alternative space, and it leads me to maybe a slightly off script question, but a bit of an unusual one. Is the word alternatives too reductive now? Is it have we moved as the industry has gotten more sophisticated, should we actually stop saying alternatives and start talking about those four food groups and the contents within them as just, at least more instructive and illustrative language?
Yeah, I think two things can be true at the same time. So I agree with you 100%. And I think that only becomes through further education. We always say, equity and fixed income. So let's talk about that for a quick second. We all know what an equity is. Let's check that box. Okay. I think now over time, and sadly, absolutely, it's not known by all investors. And that's why more and more we're being looked to as fiduciaries, and there's more regulatory oversight and CIRO and all of the various compliance regulatory bodies. We need a few bad actors spoil it for the many. But when I look at it, let's just talk about equities. Okay, well, this is an equity. Okay, is it a large cap equity? Is it mid cap equity? Is it small cap equity? Is it growth? Is it value? Is it profitable? Is it momentum based? There's so many ways that you can slice that. And so we see all the time through regulatory actions is that the client didn't understand. They thought they were in a portfolio of equities, and they were, but they were somehow steered into micro cap equities and biotech startups. But, that's a little different than owning Johnson and Johnson. It's so I think yes, alternatives is overused, but it's going to only be through modalities like this and investment by industry and groups like yourself where we come out and say, yes, this isn't an alternative investment. And that's the word that we've created to capture everything outside of a conventional stock or fixed income security that's not publicly traded on a stock exchange. But within that, it's important that we educate, and hence why I wrote the book, was to say there are more complexities into that.
Let's go back though into that first vehicle that you created for your clients. You have a hypothesis, you believe that this can deliver returns, and over the course of your subsequent career, you've seen that hypothesis tested. I guess what signaled to you that this should become a central part of your investment philosophy? What about those first few assets and experiments, as it were, in alts made you
Mhm.
think this is a key area, this is a growth area, and this is what I need to give clients exposure to?
Yeah, and I think it's a selfish answer, and it's also a pragmatic answer. The When you can align, I've always worked, I had a brief stint where I worked at, one of the big banks, but I've largely maintained my career independently, and I've never had the pleasure or gift of kind of being, force-fed client relationships from the parent. I've always had to uniquely position myself in the marketplace. At the first kind of go around, we definitely recognize that having a differentiator and what things that would call it be on shelf or being available through us, it took a lot of work and continues to take a lot of work. These are not things that are just ready and available, on the shelf to be picked and choose from. And so that additional effort to curate and create a platform whereby clients would have access to investment strategies, styles that they would just never be able to access at the larger competitors really stood out. And it used to be that you call it the shiny spoon to get the attention of the big fish, so to speak. But we really made the foresight and had the confidence in our value proposition across our whole platform to say, hey, listen, yes, you can come to us for your trick shots, for your really unique investments that you're not going to be able to access at your conventional vanilla, bank-owned platform. But I'm also aware that you would have a large bucket or sleeve or portfolio of beta producing in line with market results portfolio with another advisor. If you want, the VIP experience and access, we're going to need, some of that baseline assets, because I would argue to the client that, dollars for donuts, throughout a market cycle, if we're trying to achieve beta like results and get our fair share of market returns, that's become, a near commodity, whether it be through ETFs or digital platforms or just conventional TSX 60 or S&P 500 type content. We're talking about basis points of competitive advantage. So I would say, hey, I'll work my tail off over here and curate an incredible sleeve whereby we will allocate to a percentage based on the client's unique liquidity, risk tolerances, time horizons, et cetera, through a robust, diligence and financial planning discovery process of where this would fit within the client portfolios. But I need a little bit of bench strength here too. I need kind of the mashed potatoes on the table before we decide where we're going to put all the gravy.
Other advisors will be looking at your award win and the broader trend in the industry that it represents, the adoption of alternative strategies, of this increasingly sophisticated menu of options that are being available to clients, and actually what many clients may be reading about and starting to demand of their advisors. What can advisors do to appropriately educate themselves and guide their clients through this environment? Because as you say, that broad alts wrapper is maybe not fully understood. And then you also have the fact that these are somewhat less regulated, somewhat more opaque investments, and there are just risks of knowledge that could emerge out of this environment. So what can advisors do to actually be, good guides to their clients in this space?
It's a great question. It's something that we, pragmatically, holistically, altruistically discuss internally at my level and above. Is we have more and more obligations under our regulatory regime, under the KYP, the Know Your Product. If these products are sophisticated, many products, even outside of the alternatives, whether it's being structured notes or albeit hybrid preferred shares and different, the industry continues to create structures that are just unconventional, or I guess, well, let's call it alternative. So I think there's an onus on industry to ensure that KYP education becomes significantly higher. It's all great that I understand the KYP, but I should have also that obligation of passing that on to the client. I don't necessarily, it's like the T's and C's in the small print of any contract that you sign, just because they acknowledge the risks of illiquidity and they acknowledge through all the skull and crossbones things that clients have to initial, to invest capital in these structures. I think we have to take it a step further. And I think that's what creates trust and confidence within between the institution and its client base, or the advisor and its client base, is to really invest that time and educate them. It can't just be like, well, I sent them the offering memorandum and the subscription agreement and they initialed where they were supposed to initial. So we owe it as an industry. But I think, and what you're seeing is you're seeing more groups, firms invest with third parties or strategic joint ventures with high caliber groups to create evergreen structures and product that's giving the opportunity. So I did go and create, so additionally, aside from the book that I launched, is I launched the first of its kind in Canada. I launched a offering memorandum fund in partnership with a group called Obsido out of Toronto, and created a one-to-many strategy, and it's called the Alterna Private Income Portfolio. And it is a one-to-many strategy that is curated to have almost 13 different managers inside of one single ticket solution that was highly curated, diligenced, both by myself. But what was, to me, was really impactful is Obsido's group is also in partnership with ACG. It's a subsidiary of the Guggenheim group. They advise on over $157 billion of capital with only 150 clients, us being one of them, whereby nothing can get onto shelf or with inside the ecosystem until ACG, who has no conflict of interest, is a complete third party scrutiny of capital, of structure, of diligence of managers, until it passes the muster and goes through the third party diligence. It's not even available to be on shelf. So more checks and balances and guidelines and guideposts of what can get into the system. But then again, is that when we structure it down to unique clients, is not treating an opportunity or a fund or a limited partnership or a special purpose vehicle as a unique investment opportunity, but in the formation of a larger portfolio. I won't take in the interest of everyone's time, we talk largely about, vintaging. When you go and collect, an alternative asset class would be wine or sports cars or whatever it might be, collectibles. You have to vintage. You can't just make an investment in a thing and say it's going to do that thing, because different parts of the market cycle are going to perform differently, whether we're in contractive or an expansive phase or what stage we'd be at in capital markets. Is you have to, I always give the analogy, if you were a wine collector and you just blew your wad and bought all the 1979 Bordeaux that you could have, in 1981, and you had no money left to buy 1982, you really have a very different result in the portfolio return of your vintage wine collection. So you have to be at the trough, so to speak. So in the creation of this, you can't just say, I'm going to allocate 20% of my client's capital to this alternative thing. You have to create a liquidity modality and a structure whereby you can continue to vintage and get the overall exposure. The same thing we talk about within equity investing. If you're dollar cost averaging, if you're selling when things are low and buying them when they're high, time in the market always beats timing the market. It's an academically proven thing. So time is on our sides with alternatives because liquidity is low. But where a lot of advisors and clients go wrong is they put all their money into this one thing because they think it's going to do really great, and they have no ability to survive periods of illiquidity and or bifurcations, dislocations in the market to take advantage and buy more of those things.
I think it's really interesting the way you present managing alternative strategies as stemming from some of the same core common sense principles that advisors use in public assets, right?
Mhm.
Again, dollar cost averaging, for example, in equities, or just broader diversification within that subset of equities. But we don't necessarily see that same degree of sophistication in alts simply because of their novelty, because of some of the black boxes involved in this. But just by trying to open those boxes and by trying to apply those same principles, a similar kind of degree of sophistication can then be achieved almost as a reflex more than just as something you need to be incredibly like acerbic and think about. Is that sort of a fair characterization of some of the approach?
You nailed it. I think more than exactly. You said it. You summarized my big rant into 30 seconds, so I should use you more. You should become my GPT. So I appreciate that. Yeah, I think having discipline is important. I'm not sitting here just on a sole mission to plug Obsido, but having some evergreen ability to create the diversification to be able to spread and diversify across multi-managers, multi-sectors, multi-modalities, but being able to then be able to execute. I said I have a high IQ and EQ, and it's not intelligence quotient. I think it's implementation. We all know how to be a good investor. Kind of Warren Buffett and Benjamin Graham kind of taught us the way, but are you fearful when everyone's excited? Are you excited when everyone's fearful? Are you paying yourself first and have a savings cadence that you stick to? All of these basic core principles when it comes to simple investing, do you implement them? And the other part of the EQ, aside from the emotional quotient of being able to connect to people and understand their why, understand their story, their liquidity, their risk tolerances, but the EQ is really on execution. We know how to do the basic things. I want to go for a run. What do I need to do? I need to stretch. I need to get rest. I need to hydrate. I need to put on my shoes. So before I just sit there and say I'm going running, if I just took off out of here, like within a block and a half, I'm probably wearing the wrong shoes. I'm tired. I have no game plan. I have no water. All of these, I have no route planned. So being able to implement, but being able to execute, and some of these evergreen structures, that have been created are being launched across Canada are going to give advisors and their clients an incredible leg up. It would be like that one-stop shop. Oh, I need to go here to get my electrolytes, my water, my map, my, my race penny. Great. So that's what we're most excited about is modalities for advisors to access because, like you said earlier, clients are demanding this of their investors. So you need to be there. I'm not saying everyone needs to become a subject matter expert, but partner with them.
Mhm.
Partner with the best, and I think it will be. It's not a race to the bottom of fees. These are tougher and tougher to access. So the scale and pooling, the minimum threshold to access a lot of these investment opportunities is significant. And so
Mhm.
your advisor needs scale, your firm needs scale, but also the structures, are going to benefit to allow people to access, to make sure that they're not caught overweight and having to buy too much to meet a minimum threshold and then putting themselves in a liquidity crunch.
So you mentioned the firm aspect, and what occurs to me as again we introduce a completely a sophisticated asset class that requires a lot of research, it requires a lot of knowledge. You know, no one is an island, and there is
Mhm.
so much in the way of KYP regulation being put before advisors right now. Expectations that they also offer estate planning services. Scope creep is such an issue in this industry. What can firms do in the alternative space to equip advisors with the right information and that right kind of guidance skill without making this another piece of onerous, oh God, now I have to keep an encyclopedia in the back of my head kind of way of operating for advisors.
Simply, I think it's a great tee up. Partner strategically. We've seen some of the big banks and even a couple of the independents make a lot of noise and partner with, everyone's looking for that shoulder rub of brand recognition, like, ooh, this firm has announced a strategic partnership with so and so, and it's a big banner name and it sounds cool. So that association rub off of reputation. No one person does everything really well. I've always said, am I going to, I'm a portfolio manager, but I've truly transitioned and taken a view, within the beta part of the marketplace of things that can be accessed on regular exchanges is that, how can one manager, one portfolio manager, one firm even say, I'm the best Canadian equity manager, both in large cap and in small cap and in mid cap. I'm the best US manager through value, through growth, through small, mid, et cetera, et cetera. I'm the best fixed income manager. So to be able to say, look, I've put my arm around this, nice shiny thing, I'm not teasing this, Amazon's an incredible place for me to go get certain things done within my own life, to get certain goods. Well, I can't also get my groceries. I can't also get my, bespoke items. You need to partner strategically with groups to seek institutional level access through trusted and platforms and managers. And that's much like we did with Obsido. I said, where is an independent partner that is going to bird dog and create and carve pipes and structures whereby we can go anywhere and we can go on the responsibilities of doing all of that, but that arm's length partnership where there is no conflict of interest, there is no asset management arm that has a vested interest in a co-revenue share agreement that we're going to tell all advisors to go and buy our thing that we made and have an economic interest. So partnering strategically with an independent group, again, to seek institutional level access is, I think, number one. And then start with educating the clients, building some internal capacities to, again, trust but verify, develop rigorous due diligence and be able to. I love to review diligence that's done by everyone else, but I also have to know what a diligence report looks like. And I have to be able to call BS through it and be able to say, well, I have a diligence report. It's on the corner of my desk, because this consultant or this group says they've done diligence. I have to be able to have the core competency to review that for manager selection and ongoing monitoring frameworks. That would be how it help firms adopt that alts and clients portfolio strategy.
With that note and with that guidance for advisors and firms in this, I will have to say that unfortunately we have run out of time for our session today, but I just want to say thank you for the
Pleasure.
fascinating insights and just deep expertise in this area that so many advisors want to know more about. So really appreciate your time.
Oh, thank you so much for having me. Look forward to this again.
Of course. And thank you to all of our viewers for WPTV. I have been David Katai. Have a great rest of your day.